In this video, we're going to talk about how to calculate the true cost of a mortgage. Now, when you're paying back your mortgage or your loan, there's two parts to it. The principal of the loan that you've received in the beginning, that's simply repayment. But the real cost is the interest that you pay. And we're going to talk about how to calculate the total amount of interest that will be paid during the time you're paying back that loan. And that's going to be part C to this problem. So let's go ahead and begin. Lisa takes a 30-year term, $500K loan to purchase a home at a fixed annual interest rate of 6%. Now she puts 10% down towards the mortgage. What is the monthly mortgage payment? So let's begin with the formula that we need to get the answer. The monthly payment is going to be the principal times the annual interest rate divided by n, and then all of this is going to be divided by 1 minus 1 plus r over n raised to the negative nt. Now, what is the principal? Normally the principal would be the 500K loan, but that's not going to be the starting balance because she puts 10% down. So first, we need to find out what is 10% of 500K. To find 10% of anything, simply move the decimal 1 unit to the left, or you could multiply 500K by 0.10. 10% as a decimal is 10 divided by 100, and that will give you 0.1 or 0.10. So 500K times 0.10 is going to give us 50K, or 50,000. So that's how much she's putting down towards the mortgage. She put $50,000 in cash towards it. So now the new balance is going to be initially, the new initial balance is 500K minus 50K, which is going to be 450K. So that's going to be P, the starting principal of the loan. Before we plug in our values, let's write down what everything equals. So P is going to be 450,000. R, the annual interest rate, that's 6%, but we need to convert that to a decimal. So 6% divided by 100, that's 0.06. So that's our R value. N is the number of payments that will be made in a single year. Since we're trying to calculate the monthly payment, and there's 12 months in a year, N is going to be 12. T is the term of the loan in years. So this is a 30-year term mortgage, so T is going to be 30 years. Now, let's go ahead and plug our values in to the formula. So let's replace P with 450,000, and this is going to be times R over N. R is 0.06, N is 12. And now let's divide that by 1 minus 1 plus 0.06 over 12 raised to the negative nt. N is 12, T is 30. Now let's simplify the math before we plug everything into the calculator. 450,000 times 0.06 divided by 12. That's 2250. One plus 0.06 divided by 12. That's 1.005. 12 times 30 is 360. So there's going to be a total of 360 payments, 360 monthly payments that's going to be made over the course of 30 years. So this is going to be raised to the negative 360. And don't forget that negative sign. Now plug these values exactly the way you see it in a calculator. using the brackets and instead of parentheses here. If you type it in correctly, you should get $2,697.98. So that is the monthly payment that will be made each month for the next 30 years. So that's the answer for part A. What is the monthly mortgage payment? Now we're going to move on to part B. What is the total amount that she will pay in 30 years? So to calculate that, it's going to be the monthly payment times there's 12 months in a year, and then for 30 years. So to get B, all we got to do is multiply the monthly payment by the 360 months that are in the 30-year term. So she's going to make this payment 360 times. So the total amount that she's going to pay over 30 years is $971,272.80. So that's the answer to part B. Now let's move on to part C. Calculate the total amount in interest that will be paid during this time. The total amount in interest is going to be the difference between the total payments that she made over the course of 30 years minus the principal balance of the loan and taking into account her 10% down payment. So we need to subtract this number, $971,272.80, and we could simply subtract it by 450K. But if you want, you can subtract it by 500K. That's the original balance of the loan. But you need to add the $50,000 that she paid at the beginning, because this is not the only amount that she paid. She's going to pay that over the course of 30 years, but she paid $50,000 at the beginning. So we need to add that as well, because that's part of how much she paid in total. So it's $971,272.80 plus $50,000. So she put in $1,021,272.80 minus the $500,000 loan that she got. So the total amount that she paid in interest is $521,272.80. So this is the true cost of the loan. That's how much she's paying in pure interest. So now you know how to calculate it using a formula. Now let's go ahead and confirm our answer. So if you go to Google and you type in online loan calculator and go to bankrate.com, you can get to this page. And so this is a very simplified way of getting the same values without doing any math. So in this problem, the loan amount is going to be the difference between the principal and her initial deposit or down payment. So that was $500,000 minus $50,000. And so her starting loan balance was $450K. The loan term is 30 years, and the interest rate was set at 6%. And as you can see, this is the answer that we got. It's a rounded answer, but that was the answer that we had, $2,697.98. So the total principal paid is $450K. The total interest paid, this is the answer that we got in part C, is $521,271.85. Now, we didn't get exactly that answer. our answer differed by around $1 because we had $521,272.80. The difference has to do with the fact that when we calculated the total interest paid, we didn't use the exact value. We used a rounded value. The monthly payment was rounded to the nearest cent. The actual answer was like 0.9765 something. But if we were to use a more exact answer, this would be more accurate. So the reason why we're $1 off is because we rounded our monthly payment and we use the rounded answer in part A to get the answer in parts B and C. So that's why it's about $1 off. But nevertheless, the process does work. As you can see, this is still a very good approximation. So now you know how to calculate the true cost of a mortgage or of any loan. It's basically the total interest that you're going to be paying over the course of 10, 20, or 30 years. If you want to reduce the total interest paid, one of the best ways to do that is reduce the annual interest rate or increase your monthly payment by trying to pay off the loan a lot faster. If you can decrease the loan term by increasing the monthly payment, there's less time for interest to build, and so the total interest paid will be much less. If you can change it from a 30-year term to a 15-year term. And we can see that. If we change this to 15 years, notice that the total interest paid is less than half of what it was. Now imagine if we can simply cut the interest rate from 6% to 5%. If you could just renegotiate the 6% interest rate to a 5% interest rate, you would save over $100,000 in the course of 30 years, which is a lot over time. So that's how you can reduce the true cost of the mortgage. Number one, try to get a lower interest rate. Number two, try to pay it off a lot faster, even though you may have to increase your monthly payment. Look at the difference here. So a 30-year term, the monthly payment is about $2,700. If you paid off in 15 years, your monthly payment doesn't double. It went from $2,700 to $3,800. So an increase in just $1,100 caused interest, the total interest paid, to be reduced more than half. So you didn't have to double your monthly payment, and yet interest, the interest paid, was reduced by more than half. So this actually saves you a lot if you can pay it off faster. So just some things to consider if you want to take out a loan of any kind, be it a car loan, a mortgage, or some other kind of loan. If you can pay it off a lot faster, you're going to save yourself a lot of interest over time.